The line between speculation and gambling is drawn not on a chart, but in the mind of the operator. One is a calculated intellectual endeavor, the other a desperate appeal to chance. The market does not distinguish between the two. It simply takes the money from the hopeful and gives it to the disciplined. If you see yourself in the warnings that follow, understand that you are not trading. You are making a donation to the accounts of professionals, and your ruin is not a matter of if, but when. The first and most telling sign you are a gambler is that you trade for the thrill. You crave the action. The quiet hum of a sideways market makes you anxious, not because you are missing an opportunity, but because you are missing the excitement. You equate trading with doing, and you feel that if you are not in a position, you are not working. This is a profound and costly error. I learned this as a boy in the bucket shops. These were not legitimate exchanges. They were wagering houses that took bets against their customers on stock price fluctuations. The entire business model was built on human impatience and the love of the game. They profited when the customer lost. I was barely a man, but I had a mind for figures and patterns. I would watch the ticker tape, the scrolling feed of prices that was the ancestor of your modern real-time chart, and I could feel the next small move. I would place my bet and win. I won so consistently they eventually threw me out. I thought I was a brilliant trader. I was not. I was a high-speed gambler. My mind was consumed with the 5- and 10-point moves. I was playing for pocket money, exhilarated by the constant battle. This craving for continuous action blinded me to the real business of speculation, which is to capture the great swings. A man cannot prepare for a tidal wave if he is busy trying to catch every ripple. He is too occupied, too focused on the immediate thrill to see the larger, more powerful forces gathering on the horizon. The gambler seeks excitement. The speculator seeks capital appreciation. The two objectives are irreconcilable. The law of purposeful inaction is therefore your first defense against this impulse. Understand this. Your job is not to trade. Your job is to make money. And the way to make money is to wait, with absolute ironclad patience for the stars to align. You wait for the market, the sector, and the individual stock to all confirm the same story. This may happen only a few times a year. In the interim, your position is cash. Your activity is observation. Your state of mind is a patient readiness. If you find yourself placing a trade because you are bored, you are paying the market for entertainment. You must diagnose this impulse as the gambler's disease, and the only cure is to walk away. The market will be there tomorrow. The question is, will your capital? A professional is defined not by the trades he makes, but by the foolish trades he refuses to make. The second sign is that you trade without a predetermined stop-loss. When you enter a position without knowing the exact point at which you will exit at a loss, you have not made a trade. You have made a commitment to hope. Hope is the most virulent poison in a speculator's toolkit. It clouds judgment, defies facts, and transforms minor, manageable errors into account-destroying catastrophes. I learned this lesson at a price so high it cost me everything I had. I was trading cotton, and I had built a very large position. The market was not acting right. It was weak, and every sign from the tape told me my premise was wrong. The intelligent thing to do was to sell, to accept a small loss and preserve my capital for the next opportunity. But I did not. I held on. The price dropped further. My broker called, his voice tight with concern. I told him, with a confidence I did not feel, that I simply needed a rally to get out. I was no longer speculating on facts. I was praying for a miracle. I was hoping the market would bend to my will. The market, of course, did no such thing. It continued its decline, and that hope, that refusal to take a small, prudent loss, magnified my error until it consumed my entire fortune. This brings us to the law of predefined risk. A stop-loss is not a sign of weakness or an admission of failure. It is a business expense. It is the cost of gathering information. When you place a trade, you are testing a hypothesis. The stop loss is the price at which your hypothesis is definitively proven wrong. It must be determined before you enter the trade based on a technical level on the chart, not on the amount of money you are willing to lose. It is an objective line in the sand, not an emotional pain threshold. Once you have determined this price, you must honor it with the blind faith of a zealot. You place the order to sell and you do not cancel it. You do not move it further away because you hope for a rebound. You do not second-guess it. You accept the loss mechanically, dispassionately, and you move on. Trading without a stop is like driving a car with no brakes. You may enjoy the speed for a while, but your destination is a brick wall. The third sign you are a gambler is that your position size is dictated by greed, not by prudent mathematics. You are trading too large. The evidence of this is not on your screen, but in your stomach. If you find yourself watching every tick of the price, if your heart pounds when the market moves against you by a fraction, if you cannot sleep at night for fear of what the opening will bring, then you are not speculating. You are carrying a burden too heavy for your capital and your nerves to support. Your judgment is compromised. I learned this when trading Union Pacific early in my career. I was absolutely certain of the direction of the stock. My analysis was flawless. It was destined to go much higher. I plunged in, taking on a line of stock that was enormous relative to my capital. Then, the stock had a perfectly normal, healthy reaction, a small pullback that was nothing more than a pause in the trend. But for me, because my size was so immense, this minor wiggle was a cataclysm. The paper loss was so great it generated a margin call, forcing me to sell my entire position at the low. A few days later, the stock resumed its upward march, just as I had predicted. I was right on the market, but dead wrong on my money management. I was shaken out of a fortune because of greed. The law of emotional capital governs this. Before any trade, you must sell down to the sleeping point. Your position must be small enough that it does not engage your emotions. Fear and greed are the speculator's twin enemies, and they are both amplified by excessive size. If a trade is keeping you awake, your subconscious is telling you that your risk is too great. Listen to it. It is a more reliable indicator than any analyst's report. Cut the position in half. If you are still anxious, cut it in half again. Keep reducing until the trade becomes a matter of intellectual curiosity rather than a source of visceral fear. A small position in a correct trend can be pyramided into a fortune. A large position in that same trend can cause you to panic and sell at the worst possible moment. Your goal is not to get rich on one trade. Your goal is to survive to trade for the next 20 years. Only sane, rational position sizing makes that possible. The fourth sign is that you are praying for a move instead of planning for it. This is a subtle but critical distinction. The speculator operates from a position of evidence. He sees a stock consolidating in a tight range on decreasing volume. He sees the general market is in a clear uptrend. He sees the stock's industry group is leading the market. He forms a hypothesis. If this stock breaks above this specific price level on high volume, the line of least resistance is upward, and I will buy. His actions are conditional, based on the market confirming his thesis. The gambler, however, operates from a position of desire. He buys a stock because he heard a rumor, or because he likes the company's story. The stock then drifts downward. He does not have an exit plan. Instead, he begins to hope. Please let it go up, he thinks. He is no longer analyzing the tape. He is petitioning it. He is looking for divine intervention to save him from his own lack of preparation. When you are wishing, hoping, or praying, you have ceased to be a market operator. You have become a member of the public, and the public is always the ultimate loser in this game. This is why you must obey the law of observation over expectation. Your job is not to predict. It is to react. You must be a clinical observer of market facts. What is the price doing? What is the volume telling you? Is the action of the leading stocks confirming the move? These are the questions of a professional. The gambler asks, What do I want this stock to do? It is a fatal question. If you ever find yourself hoping for a particular outcome, it is a red flag that your emotions have taken over your intellect. Your position is compromised. The only correct action is to close the trade immediately. Get back to the safety of cash. From that neutral vantage point, you can reassess the situation without the distorting lens of hope. The tape tells a story. Your job is to read it, not to write it. The fifth sign of a gambler is the most destructive habit in all of finance, averaging down on a losing position. This practice seems logical to the untrained mind. A man buys a stock at 50, it drops to 40. He reasons, it was a bargain at 50, so it's an even better bargain at 40. I'll buy more and reduce my average cost. He feels shrewd. He is, in fact, committing financial suicide. He is not averaging his cost. He is compounding his error. The stock was weak at 50, which is why it dropped. It is demonstrably weaker at 40. By buying more, he is not being an investor. He's being stubborn. He is arguing with the tape, and the tape always has the last word. He is sending good money after bad, reinforcing failure. The intelligent speculator does the exact opposite. He adds money only to his winning trades. He pyramids. He waits for the market to prove him right. Then he increases his bet. The law of profitable reinforcement must be burned into your brain. You will never, under any circumstances, add to a position that is showing you a loss. That is the cardinal sin. Your initial loss is always your best loss. It is the cheapest one. Your capital is your ammunition in this war for profits. To waste it on a losing campaign is inexcusable. Your money must be directed with ruthless efficiency toward the trades that are working and away from the trades that are not. When a stock moves against you, it is not an opportunity to buy more cheaply. It is a warning signal from the market that your initial judgment was wrong. You must heed that warning by selling, not by doubling down on your mistake. Add to your winners. Cut your losers short. It is the simplest rule, and yet obeying it requires a level of discipline that separates the 90% who lose from the few who consistently win. The sixth sign is that you act on tips and rumors. You listen to the advice of others instead of conducting your own analysis. The allure of a tip is powerful. It promises easy money, a shortcut past the hard work of studying charts and reading the tape. But a tip is a trap. It is a siren's call that leads to ruin. No one gives away a fortune for free. If the tip were truly valuable, the person giving it would be silently mortgaging his house to buy the stock, not broadcasting his intentions to the world. A tip serves the teller, not the told. I learned through painful experience that my greatest successes came when I was most isolated. I would retreat to my private office away from the noise, the opinions, and the friendly advice of Wall Street. In silence, with only the ticker tape for a companion, I could think clearly. I could see the patterns. I made some of my worst trades immediately after breaking this rule of isolation, listening to a charismatic and supposedly well-informed man tell me a story. I abandoned my own method, a method that had been proven profitable, to follow his narrative. I lost a fortune. The monetary loss was painful, but the real damage was the erosion of my self-reliance. Following a tip makes you mentally lazy and psychologically dependent. It destroys the very qualities a speculator needs to survive: independent judgment and the courage to act on it. My entire education in this unforgiving business is detailed in Reminiscences of a Stock Operator. I insist that any man or woman who is serious about this profession study it not as a story, but as a textbook of errors to avoid. The link is in the description of this video. Therefore, you must live by the law of intellectual sovereignty. You and you alone are responsible for every decision and every outcome. You will not act on the advice of a broker, a television pundit, a newsletter, or a friend at a dinner party. You will do your own work. You will study the general conditions. You will identify the leading groups. You will read the price and volume action of the leading stocks. You will form your own thesis. You will execute your plan. And you will accept the results, win or lose, as your own. If you win, the credit is yours. If you lose, the lesson is yours. If you cannot accept this absolute responsibility, you are not prepared for this business. You should put your money in a savings bank and forget the stock market exists. Finally, the seventh sign you are a gambler is that you operate without a defined method. You have no system, no set of rules, no written plan. Your trading is a series of impulsive, disconnected decisions based on gut feelings, news headlines, or what seems to be moving that day. This is the amateur's approach, and it always ends in the same place, a zero balance account. For years I had a talent, a knack for reading the tape, but I did not have a system. As a result, my career was a violent series of booms and busts. I would make millions, then lose it all, because my success was based on instinct rather than a repeatable process. The great turning point of my professional life was when I stopped being just a tape reader and became a student of the market. I spent months studying the great trends of the past, looking for the common characteristics of bull and bear markets. From this study, I developed my trading philosophy, the pivot point system for timing entries, the rules for pyramiding, the absolute necessity of cutting losses, and the critical importance of sitting tight. My trading became less of a frantic art and more of a calm, calculated science. Success became more consistent because it was built on a foundation of logic and historical precedent, not just on flashes of intuition. The law of the written plan is the final barrier between you and the gambler's fate. Before you risk another dollar, you must create a formal trading plan. It must be written down. It is your personal constitution, and it must not be violated. This document must state in clear and unambiguous terms what constitutes a valid entry signal for you, how you will determine your initial stop loss, how you will trail that stop to protect profits, what your criteria are for taking profits, how you will determine your position size, and under what general market conditions you will not trade at all. This plan is your commander in the heat of battle. When the market is moving quickly and the twin impostors of fear and greed are screaming for your attention, you will not have time to think. You must simply execute the plan you created when you were calm and objective. Trading without a plan is not trading. It is hoping, guessing, and gambling. It is a business plan for failure. Eliminate these 7 behaviors and you may have a chance. Continue in them and your failure is guaranteed. The choice is yours.